Trading is a relatively simple affair compared to other activities that people might undertake. You're certainly not attempting to land a jumbo jet in a thunderstorm or remove a brain tumour that is buried deep within someone's skull. And as such, it can be defined in what I consider to be three very, very simple rules. You buy when the market is trending up, you sell when the market is trending down, and you don't bet the farm. The unfortunate thing is that most traders do the reverse, and that is in many ways the prime catalyst for their failure. But there is actually another mistake that traders undertake that is perhaps even more costly. And by more costly, I mean in terms of the emotional effort that goes into it, the time they waste, the capital they deploy to it that is sitting doing nothing, and the opportunities that exist elsewhere that they can't take. And this is this notion that traders are drawn to a dead zone. And they're drawn to this zone in much the same way as moths are attracted to a flame. And it has the same result for the trader as it does for the poor old moth. And I want to look at this using an example of one of our more popular domestic shares. This is CSL. CSL has been a darling of portfolios for a very, very long time. And what this graph shows you is the value of $10,000 invested in 1995 and its current value now. And as you can see, your $10,000 would have grown to a staggering $5.2 million. And if we compared CSL to a series of other stocks that were considered foundational stocks for portfolios way back in 1995, you can see that their results are nowhere near as impressive. The closest is Cochlear at 1.6 million. And of course, Qantas is bringing up the rear with a mighty $68,000. And if we look at the compound annual growth rate of these stocks, you can see a similar pattern emerge. But what many people gloss over is this column marked maximum drawdown. And that gives us a little bit of a clue as to the problem we run into with this notion of dead zones. To hold your CSL through that period, you would have at some stage have had to experience a drawdown where you lost 76% of the value of your portfolio. And this is why these charts are somewhat misleading, because what they assume is massive survivor bias. They assume that someone has simply bought the stock in 1995 and they're still holding it now. Granted, there are probably one or two very lucky people out there who have done that, but they would probably be as rare as hen's teeth, as they say. But there is a problem within this notion of drawdown and holding these stocks for a very long time. And we can graph drawdown quite easily. And you can see that CSL has a series of drawdowns, series of periods where it goes nowhere. And it is more these periods of going nowhere that I'm interested in. It is these dead zones that chew up time and occupy capital. And if I were to break these down for CSL, and I were to look at the three longest in terms of weeks, you can see these are quite substantial periods of going nowhere. We have 273 weeks, 221, and the current period is ticking along at about 188 weeks, which is a substantial period to be sitting in a stock doing nothing. And we can actually visualize what this looks like. This is CSL. This is a weekly chart from 2000 to 2012. You will see that there is a red line intersecting price at certain points. This is an intermediate length moving average. I understand that some people will get their knickers in a twist as to what the length of that moving average is and what type it is. Is it 30 periods? Is it 31? Is it 33.5? It might be 44. It might be weighted. It might be simple. It might be exponential. If you are obsessed by such questions, you are actually looking in the wrong spot. Because as a tangential point, Your trading success does not in any way, shape or form revolve around the length of the moving average or any other indicator you use. Yes, I understand that you may have heard something different from a 12-year-old on the internet who still lives in his mother's basement. But that's incorrect. The skill in trading, as we will see, is in trade management. It is knowing when to be in a position and when not to be in a position. If we break this down, we can see that there are times when CSL makes money for traders and a time when it doesn't. And these periods I've just denoted here by blocking them in blue. We can see there's one from 2000 to 2002. There's another one from mid-2003 through to mid-2008. The periods marked in red are periods where you do not own the stock. Now, the complication is that the first one is very obvious because price collapses below the moving average and trends down. Very easy to see. The second one is slightly more complex in that price just seems to meander, and it meanders around the moving average. And this is one of the drawbacks of moving averages as a tool. When markets begin to meander, they are useless. So that raises the question, why use them? Well, they are part of the sort of cornucopia of tools that you employ. There is no magic single bullet in trading. I do understand that people would like one, I would like one, but there isn't one. So what we have to do is generate a rule. And the rule is based around a simple fundamental principle of the way markets trend. If we look at this chart without its coloured zones, I've denoted a point on here where price does something very, very simple. It fails to take out the previous high. It does not move forward. And this breaks the very, very simple rule of how we define an uptrend. We define an uptrend as simply higher highs and higher lows. And this comes to our solution of not being involved in these dead zones. If your stock or your commodity, your options price, your futures contract, whatever, is not doing this and you are long that instrument, there is no reason to own it. There is simply no reason you should be involved in it. And what is interesting is this notion of holding instruments through periods of congestion, periods where they're effectively worthless for you, is not confined to stocks. This is New York cotton, a commodity. This is a futures contract. And you can see there is an extended period of congestion going back a year. We have to be a little bit careful with the interpretation of this with commodities markets because there are some nuances within them that, whilst you don't necessarily need to be aware of, they do influence our interpretation of this a little bit. So there will be people within this zone who are hedgers. They are hedging the physical commodity, and that is their role. So that's the reason they're taking positions. There will also be people who are taking very, very short-term positions and who are attempting to trade very, very small movements. Those two types of market participants are different to what we're talking about. There will be position traders in here who look at this chart of cotton and go, that's magnificent, it's going sideways, I'll go long. And so they sit there, and they sit there, and they sit there, and their contract expires, and they either get stopped out, or they roll it into the next one, and they simply sit and wait. If you have a chart that looks like this, there is simply no reason to be involved at all, because we default to our notion of simple rules. And if you can't define or explain a topic with simple rules, you simply don't understand the topic well enough. And in trading, for long traders, and the majority of equities traders are long traders, the rule is simply this. We default back to this. If the instrument is not making higher highs and higher lows on a consistent basis that you have defined, and it could be something simple like continually making new 52-week highs. That's a metric that is often applied to equities. It is robust, it is simple, and it solves this problem because it gives you a definition. And the definition is simply, is your stock making higher highs? If it is not, there is no reason whatsoever to own it. Let somebody else own it and sit there doing nothing for years. You move on, find something that will make you money.